Corporate finance practice problem using OneNote. Dividend projection life cycle. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, Practice Problems tab, then down in the 1817 Dividend Projection Life Cycle tab. Also note, when using OneNote, look at the Immersive Reader tool. Our presentations will be mirrored down in the text area, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon on the left, we have our information up top, calculations then on down below. The problem we'll be looking into has to do with the life cycle of a corporation and the potential dividend strategy that could be put in place or the projection of it through that life cycle. So the 4 stages of the life cycle we will be considering is going to be the development stage, the growth stage, the expansion stage, and the maturity stage. Now we're doing a projection out as we think of the projection of what our dividend policy might look like. And you can also think of this would be kind of a general idea of what you would think would be happening for most businesses as they go through their life cycle. Meaning when you're in the development stage, we have 0 dividends going out. That might well be the case for many companies, given the fact that they're probably trying to generate capital during that stage. And remember, when you're looking at a larger type of business, the point is, and this can be a little bit confusing if you're in like a service business or something like that, where where the startup costs are low. If in many types of businesses, of course, the startup costs are not low. You're trying to get capital, you're trying to get equipment, you're trying to get buildings and whatnot in order to grow the business so that you can generate the income. To do that, then you're not going to be able to pay out big dividends. You're going to be keeping the money into the company so that you can buy the resources you need in order to generate the revenue. So you would think at that point, and as we are planning here, we have the dividends at 0. Then during the growth stage, the dividends as a percent of income, and note what we're projecting here is the dividends based on basically the income level, we're increasing. So they'll increase the income level we're hoping is going to go up during these stages of development, of course, and the dividends will be based on the growth, the income. So now we're saying 15% of the income. So income going up, and we're taking some kind of percentage, which will probably go up as well, of the earnings during this part of the life cycle. Now you would imagine then that the income level per year would also be increasing as we go through these stages as well. And so this would kind of follow. You would think, okay, at some point in time, the shareholders, as the company grows, is going to want to see a return on their investments in order to, get a return at that point. So we're saying 15% then. Then during the expansion stage, the payout ratio we're going to say is 32%, which once again might be something that you would expect if the company is then growing. You might see an increase to the dividend level, again, both in terms of income itself, hopefully going up as we expand. The idea of it expanding would indicate that it would be going up, and you might see then an increase of the income as a basis of, at this point, again, on the income. And then at the maturity stage, the payout ratio, we're going to say it's 51%. Now, note when you're at the maturity stage, even if you're talking about a business that has a lot of capital that's needed to basically get the business going, you can imagine a situation when at maturity where that capital is not as necessary for the growth stage. If you're building something like a factory or something like that, where you're going to be putting things together, then the growth stage is what you need. Once you have the factory put together and it's meeting the current industry needs, then you might be at a place where you can kind of level off. You're not really needing to take all that money, put it back in the business. We're also imagining at this point in time, the income is higher than it was at the beginning, probably at a point in time at this point where the income is not going up substantially each year. It's probably going up, but at a much lower pace, possibly in alignment to something above, little above, inflation at that point in time, somewhat holding steady. That's what it does in maturity. When it's in maturity, then it's going to be a stable, hopefully, at that point in time. And then you might be able to give a higher portion of the dividend since you don't have that big peak of growth that you need to use the investments of the current income in order to go at. So that's what you would commonly kind of expect to be the case for a business as it goes through its stages of development, which could vary greatly depending on the industry that the business is in. So we're then going to say that the earnings per share per stage. We're going to say in the development stage, we're going to say that it's going to be the 0.25. Now, when we think about the earnings per share, clearly we're looking at there the earnings, basically the net income of the business. That's going to be the performance statement, income statement type of thing. And we're looking at that on a per share basis. So we're dividing by the number of shares so we can look at the income on a per share basis. So when we do this calculation, we're looking at it basically on a per share type of basis. During the growth stage, we're going to say it's 2. And the expansion stage, the earnings per share is going to be 3. And the maturity stage, we're going to say the earnings per share is 4.5. So you can see the income on a per share basis going up, as you would expect to be the case as we go through the stages of the development. Now, there could be differences as we go through here, because oftentimes, and possibly in the growth stage and expansion stage in particular, you might have stock dividends or stock splits and whatnot that can impact what the earnings per share would be, right? So the income that you would have for the company in total may be going up, and it may be adjusted to some degree when you have like a stock split or something, which might be done in particular in order to basically possibly lower, get the price of the stock to what the company feels is a sweet spot to be marketable on, the market or something like that. Okay, so then we're going to imagine once we go through that process that the investor shares, that we have an investor at maturity with 400 shares, and we'll do some analysis on their holdings at that point. So let's first think about where we're going to be at these 4 stages. So we got the dividends in place here. Let's look at the development stage. We had the 0.25 at the development stage. The payout ratio we said was 0. So the dividends in the development stage are going to be 0. And the next stage, we're saying that we had the growth stage at 2. We're just pulling that 2 up from our number up here in the growth stage for the earnings per share. We said the payout ratio was going to be 0.15. That's going to be up top. The payout ratio is going to be the 0.15. So if we pull out the trusty calculator, then trusty calculator is going to be 2 times the 0.15. That's going to be the 0.3 or 30 cents. Then we're going to go to, that's going to be the dividends per share. Then we have the expansion stage, which we said was 3 on the earnings per share. The payout ratio then being the 0.32 or the 32%. So 3 times 0.32 is going to give us then the 0.9696 cents dividends per share. And then finally, we have the maturity stage at the 4.5 earnings per share. And we said that we had a payout ratio of the 51. So we're taking the 4.5 times the 0.51. Hold on a second. We're taking the 4.5 times the 0.51. I had it right. That's about the 2.3 or $2.30. So that's going to be the dividends that we're going to expect. We have the earnings per share, we've got the payout ratio, and then the dividends over the life cycle of these 4 stages that we are projecting out. Then we have the investor dividend income. So let's think about that from our standpoint of a particular investor that has these 400 shares during the maturity stage, tax bracket at the 15%. So the investment dividend income, if they have 400 shares, times the dividends per share at that stage, which we calculated to be maturity stage 2.3. The 400 times the 2.3 would mean 400 times 2.3. We have the $920. Now it's a little bit different because this is rounded up, not up top. So 4.5 times 0.51 came out to 2.295. And if we take that times the 400, we take that. Let me do it one more time here. 4.5 times the 0.51 is going to give us our 2.295. If we take that then times the 400, that's going to give us our 918. So you got to deal with the rounding that would be involved there. Then we have the investor after-tax income. So what about if we take into consideration taxes? Note we're on the investor side of things, so we're considering this from the investor side of things. And also note that when the investor is getting income then on their side, income is usually bad for taxes, right? But due to the fact that it's dividends may be taxed at different rates than other income. So you could have a beneficial tax on the dividends, typically because the government doesn't want to double tax because they tax the corporation. And if you tax then the dividends, which are the distribution of the corporation, you're double taxing. And so sometimes there's going to be a lower rate. Again, that policy could change over time, but that's common common concept due to the double taxation problem. So we got the dividend income at the 918, and then we're going to take 1 minus the tax rate, which we're saying is the 15%, which once again might not be the ordinary income tax rate for the investor, and that's going to give us the 85%. So in other words, they're going to give 15% to the government. After, if they give 15% of the 100% of the tax of the income to the government, they get to keep the 100% minus 15% or 85% of the income. So if we take this 918 times the 0.85, we're going to be holding on to, as the investor, we're imagining at this point, the $780.30. So that's going to just give an idea of, in general, what you would kind of expect with regards to the dividend policy over the life cycle of a business, and then, what the impact of that could be from an investor standpoint as well. Obviously, from an investor standpoint, just to take a look at that a little bit more deeply, you got different investors that are going to be wanting in on this beginning stage to the end stage. People that want more risk that are involved, but at a higher return, are probably okay with possibly okay with the zero dividend if you got a longer perspective and you think the growth is going to happen, because you would think the growth here would be more rapid when you're talking about these stages, even though you're not going to get the dividend. If you're at a later point, typically a later point in your life, or you want more cash flow, return on your investments and a more stable investment, generally people towards the end of their investing career for individuals, then you're probably looking for this maturity stage where you have stocks that are stable and they're not going up a lot, but they're not going down, and they're paying out some of their money in dividends, which hopefully we can live on, at that point in time.